The stock market has had a crazy and wild year in 2022, and what comes with craziness is opportunity. In this video, we're going to talk about the crazy movement that we're seeing in the stock market right now. Now, this is presenting an opportunity that we haven't seen since the dot-com bubble, which was over 20 years ago. So the whole setup that we're going to be talking about today basically only happens every 20 to 50 years. So stick with me towards the end of today's video. We're going to talk about all of the everything you need to know, basically. But before we get into the really good, nitty-gritty details, we also have to talk about some important things going on with the market right now. So by looking at the S&P 500, clearly it's been in a nasty downtrend all year long, and we can see that we've just been basically channeling between this top line resistance and this bottom line support. And with that, we've had a couple pretty strong bounces along the way. The first major bounce was in March, and this was for around 12.5%. And that was basically like a full range bounce all the way from the lower support line to the top line resistance. As we moved on, we can see we had a couple smaller bounces sprinkled in here and there. One example of this would be at basically the end of May, and this was just like a 10% bounce from the bottom support line to the midpoint of this channel. But there was one really big bounce that happened in August and July and even just a little bit at the end of June, where it was like a completely full test of support and resistance. It actually broke below the main support level of the year and then ended up touching the key resistance level of the year. And that, all in all, was like a 19.2% bounce. Right now, we are in a similar situation, but currently we are getting rejected pretty hard off of that top line resistance, and this came just after the Federal Reserve increased interest rates yet again. So now the main question is, are we going to retest that bottom support line? And that's part of what we're going to be talking about in today's video, but we also have some other important things to cover. So while looking at the market overall in this situation with the S&P 500, we have to talk about the volatility index, which is the VIX. Basically, for those of you who don't know, this thing absolutely skyrockets anytime there is a lot of fear in expected volatility going forward for the stock market. What's very interesting is we look back through notable stock market crashes like what happened in 2020 with the COVID crash, and even the giant meltdown that happened at the end of 2018, and any other times where there was a lot of fear in the market. We saw VIX absolutely explode. But what's interesting is, at least over the past couple weeks, we saw a lot of selling pressure in the stock market overall. But if we look at the VIX, or the volatility index, it has actually been falling. And this has puzzled a lot of people, because normally when you see selling pressure, this pops up, and it pops up in a major way. Now, what's important to note is that basically, the VIX and the S&P 500 are not one-to-one correlated. They don't have a perfect inverse correlation. You could just say that. They don't have a perfect inverse correlation. Sometimes the market can take down, and the VIX can too. But really, what we're seeing in this situation, and what we can actually read from the VIX right now, is that yes, while the stock market is selling off a good amount right now, the overall market is not really getting spooked by it. If there was truly a lot of fear and there was truly a lot of selling pressure right now, the VIX would be exploding. And essentially what happens when the VIX explodes is it means that the prices of options on the S&P 500 are actually rising. And they rise because volatility is expected to be higher in the future, but that's not the case right now. So essentially what you need to know from the VIX's current situation is, yes, while the stock market overall is selling off, the market makers don't expect a ton of volatility going into the future right now. They're not panicking. And I think that's a good thing. That's actually a very good thing. If the VIX was skyrocketing, the stock market would likely be selling off a lot more right now. So what's interesting is what we're seeing right now is, of course, the stock market selling off, but it's not at the same pace as other sell-offs, and even other like support tests of this year. So keep that in mind. While stocks are pulling back, it's really not as bad as you think. And at the same time, a lot of it has been attributed to these big tech stocks lately. If we look at some stocks like Tesla, just over like the past week or so and over the past month, it's down anywhere from 18 to 23%. Apple, the powerhouse, is down, like around 13%. So it's like a lot of this selling pressure lately actually comes from some of the most powerful stocks in the market, like Tesla, Apple, Google, Microsoft, and stocks like that, which is interesting, and like anytime you see these market-moving powerhouses selling off, of course it's not a good sign, and realistically, it'll be extremely hard for the stock market to truly break out, especially above this resistance line right here, if these big tech stocks keep selling off. So that's very interesting. And what you can take away from this is like, if the market itself is trying to rise and, these big tech stocks like Tesla, Apple, and others aren't rising, then maybe instead of like looking to play the market overall to the upside, you might look at other stocks that are outperforming for that week or even over the past month, whatever the industry may be, whether it's energy, whether it's, whatever, value stocks, medical stocks, anything like that. So keep in mind, like, you can definitely play the industries by themselves right now, and there could be a lot of opportunity in that sense as well. Another thing I want to mention is if we look at S5TH, which in my opinion is a very great gauge of when there's a good buying opportunity in the market. I talk about this all the time, but basically whenever this data point gets to around 10, it has been an amazing buying opportunity historically speaking. We can see it is called recent bottoms in October of this year, in June of this year, and of course the COVID crash, and even at the end of 2018 it did great, and you can go all the way as far back as you want, and this data point has been amazing at calling bottoms. So anyways, that's from beside the point. Basically, anytime this data point gets down to 10, it's a great time to buy stocks, at least historically it's been, and right now we're like stuck right in the middle right now. So it's like we're looking at the S&P 500, we're stuck at a major resistance point. At the same time, the market itself, market makers, are not necessarily expecting a gigantic sell-off right now, and we can tell that by the VIX, and just other data points are kind of mixed right now, just like S5TH. And even if we transition a little bit and we look at the yields and just like the yield curve overall, we can see that the longer end of the yield curve, so like the 10-year and 30-year treasuries, have been falling off over the past couple of weeks, which is awesome. They are starting to pop back up. So basically what we want out of this situation is we want just yields, like treasuries, like rates in general, to either stagnate or come down a little bit. If they keep rising at the pace that they have been all year, that would bring a world of hurt not only for the stock market, but even for the housing market as well. And I know the housing market does tend to lag a little bit, especially compared to the stock market, but when we see yields moving the way they are, that has like a direct impact on how treasury, or obviously how treasury rates have been moving, but mortgages and auto loans and credit card rates and all that stuff, like even margin rates at trading brokerages. Like when we see yields moving like this, it has a direct impact not only in the stock market, but also in the economy overall. So we need to see these to at least start to stagnate a little bit. Like mortgage rates have doubled this year, and that's like a insane move when we're talking about mortgage rates. Like if we're looking at some penny stock and watching how it doubled, that's a lot different than, talking about treasury rates. Like that's huge. So that's definitely crazy and important to keep in mind. And what's also interesting is I was looking at some precious metals recently, specifically gold and silver. If we look at like GLD and SLV, these have been on a pretty good uptrend lately, and they've been kind of rising behind the scenes, and no one's really talking about them just yet. So what I like about gold and silver is like they kind of do whatever they want. Like sometimes they move with the markets, sometimes they don't. Over the past year, SLV has a correlation of like 0.68 to the SPY, and GLD has a correlation of 0.63 to the SPY. So it's like kind of correlated, kind of not. You could call it a moderate correlation, but either way, what's nice about gold and silver is they move by themselves for the most part. while a lot of other stocks, especially big name tech stocks, have been selling off in a major way recently. In a major way recently. Gold and silver have actually been on a pretty solid uptrend. So consider checking these two out. Gold and silver are also nice in the sense of, if we see the dollar start to fall down, that can directly help gold and silver prices. So yeah, keep them on your watch list. I do like gold and silver at this level. It's not like the best setup in the world, and gold and silver most likely aren't gonna move in an absolutely crazy way on a week by week basis. But every now and then, gold and silver do have some very strong uptrends that can last anywhere from weeks to months. And of course they have downtrends too, but they tend to move a little bit different than most other assets. But keep them on your watch list. They tend to move pretty good, especially in these times. So now I want to talk a little bit more about where the big opportunity lies. If we look at some of these stocks that are down the most this year, whether that be Meta, Amazon, Tesla, Zoom, any other companies like that, and even a lot of other stocks, not only are they down, but they're down a gigantic amount. Amazon's a powerhouse, and of course they suffered a little bit this year, as many companies did. But what's interesting is Amazon stock right now is actually at the same level it was basically at the bottom of the COVID crash, believe it or not. And actually, if we go back even further, Amazon stock right now is at the same level that it was at in June of 2018. Think about that. Amazon stock right now, if you would have bought this in June of 2018, you would be at a break even. Literally. And actually, if you bought in September of 2018, you'd be down a good amount. That is insane to think about. And with this comes opportunity, not only with Amazon, but many other companies. Now, what's interesting is if we look at, whether it be Amazon or Meta or, Apple or Zoom even, these stocks are down such a crazy amount where, assuming you like the valuation, this could be a historic buying opportunity. Now, I like Amazon, I like Meta, I also like Zoom, and there's a couple other stocks that are at pretty good valuations. But, if we look specifically at Zoom, this stock essentially IPO'd, I'll get the exact price, but this stock started trading for $65 a share all the way back in 2019. When COVID went crazy, this stock obviously exploded and Zoom went all the way up to highs of almost $600 a share, but now we're all the way back down to where it started, which is, you could call it $68. So it's what's interesting though is if we look back to 2019, which is when Zoom first started out, or at least first IPO'd, in 2019, Zoom brought in $330 million in revenue for the whole year of 2019, right? $330 million in revenue. Nowadays, in the most recent quarter, Zoom brought in $1.1 billion in revenue. In one quarter, right? So that is absolutely insane. And even if we look at it on a yearly basis, in 2022, for this most past recent year, Zoom reports their earnings a little bit differently in terms of the time horizon. If we look at the quarterly basis, technically they're into 2023, but that's a different topic for a different video. The main thing you need to know is for the most recent finished fiscal year, basically Zoom had $4.1 billion in annual revenue. In 2019, which is when they first started, they had $330 million in revenue. And even if we look at the year 2020 for Zoom's earnings, it had $622 million in revenue. Either way, it's when you look at these situations, whether it's with Zoom, Amazon, Meta, or any other stock out there, it's a lot of these stocks are trading at the same price point they were years and years ago, but their revenue is up an insane amount. And I know revenue is not everything. There's a lot more that you need to justify besides revenue before you just buy a stock. Of course, earnings are very important, and expected growth is important. The valuation is extremely important. That's important. But just by looking at this simple metric, it goes to show you how crazy the past couple of years have been. So with this craziness, look at some of these stocks that are down a ton and consider starting a long-term portfolio if you haven't already. starting a long-term portfolio is one of the best things you can do. And with stocks so low right now, it's presenting one hell of an opportunity. I know so many people looked back at the COVID crash in 2020, whether it's with Apple, Amazon, Meta, basically any stock out there, and they say, I wish I loaded up during this crash, right? Because a lot of stocks rebounded very shortly afterwards, and I know that it was a very unique economic situation where basically the government was pumping the market and the economy. But either way, the point of buying stocks when everyone else is panic selling is something to take note of, right? We have an opportunity now where we have a lot of quality companies like Amazon, like Meta, like many others that are at great levels that we haven't seen dips like this in a very long time. Like if we look at Amazon on like a weekly chart, yes, it has had some wild swings to the upside and the downside, but it is extremely rare to see drawdowns this significant. You know what I mean? Like the drawdowns we are seeing are they're extreme. You know, like when we look back through Amazon's history, whether it's the COVID crash or anything else, like we don't see drawdowns of this magnitude except for the dot-com bubble, which was 20 years ago. It's like that was the only like sort of comparable drawdown crash I could see with a lot of these companies. Like, with Amazon, with this dot-com bubble, basically they went from, after like a split adjusted basis, they went from like 36 cents all the way up to highs of $5.60, and they came all the way back down to 33 cents. So it's like that is a wild swing, and with that comes a ton of opportunity. So start a long-term portfolio if you haven't already. There's a hell of an opportunity out there for you. And of course, it can take multiple years for these stocks to recover. And stocks can definitely fall more, but nobody knows the bottom anyways. So it's important to, learn from the principles that some of the best investors out there preach, like whether it be Warren Buffett, Charlie Munger, Peter Lynch. It's like you just got to slowly buy into quality companies over time. And, if you do that long enough and the companies that you're buying into are actually good companies and are trading at good valuations, you will be rewarded over time. So start a long-term portfolio if you haven't already. I know it's kind of a boring topic, but ultimately it's the best move to make when everyone else is panic selling. So I hope you guys liked this video. If you did, make sure to subscribe. I post all the time, and let's have an amazing end to 2022.